Hi everyone, Lukasz Kalwak here from Franklin Templeton Institute. Lots to unpack this week, so let's get right to it. We'll break down what's been moving the markets and what it all means for your portfolio. Of course, we must start with the latest move from the Federal Reserve, which trimmed its benchmark interest rate by a 1/4 percentage point. Just as a reminder, this was the second rate cut this year. The Fed has flagged a softening labor market and elevated uncertainty about inflation. There was also a little surprise because although markets were largely expecting this cut, Jerome Powell signaled that another cut in December is not a sure thing, creating fresh uncertainty for investors. In moments like this, we recommend focusing on what's important and sticking to a data-driven framework. Exactly a month ago, Chris Gallipo and I published a paper analyzing how financial markets and the broader macroeconomic backdrop evolve when the Fed resumes cutting rates after a pause. The paper is available on our website, but feel free to reach out to your dedicated relationship manager if you like a copy. According to our research, volatility often increases in the months immediately after a pause cut, but investors who remain patient are typically rewarded. The old adage, "Don't fight the Fed," continues to hold true. As you can see in the chart, despite short-term pullbacks within the first 6 months, over a 1-year period, all major global indexes delivered double-digit gains, ranging from 11% in Japan, that's a green line, to plus 27% in emerging markets, that's a black line. This week wasn't just about the Fed. 5 of the big tech giants, Apple, Amazon, Alphabet, Meta, and Microsoft, all reported their earnings. The market reaction was mixed. Some stocks went up on strong results, while others pulled back as investors focused on the big jump in spending. But that spending is actually a good sign. All these companies mentioned that they can't keep up with the rising demand for AI services and cloud capacity. That's why they are investing heavily in data centers and infrastructure to meet that growing demand and stay ahead of the curve. And if you look at the chart, the big tech hyperscalers are expected to spend around $1 trillion over the next 3 years. That's more than the entire US defense budget, or even what the US spends on interest payments on its debt. In short, big tech is betting big on AI. These investments may weigh on margins in the short term, but they are building the foundation for the next major wave of growth. October is wrapping up, and it's been another strong month for equities, defying the usual seasonal jitters. The Nasdaq is on track for its 7th straight monthly gain, something that's only happened 5 other times in history. The good news? In every one of those cases, the index was higher a year later. But the short term hasn't always been as smooth. After those streaks, returns tended to get a bit choppy, and this time might be no different. Maybe we'll get a spooky Halloween hangover in November because a few signals are flashing some irrational exuberance. One quirky data point for the chart lovers. This week, the S&P 500 rose for 3 straight days, each day faster than the last, but with fewer and fewer stocks joining the rally. So what does it mean? It means that the momentum is rising, but the breadth is weakening. That pattern has only happened 3 times before, back in 1999, and each time markets turned volatile in the following weeks. That's the red vertical lines on the chart. And honestly, that wouldn't be very surprising to us. The market has made 36 new all-time highs this year and hasn't seen even a 3% pullback in over 130 days. So maybe it's time for markets to get a little spooked, and if they do, that could be your buy the dip moment. Be ready when opportunity knocks. Have a great weekend. Cheers.